Really, the goal for today is, of course, if you have questions, just throw them in the chat. I'm happy to address them. What I'm going to be going through today are my model portfolios to be able to see the performance on all of them. So really what I've done is kind of gone through and looked at the performance, just realized that I actually haven't done the Vanguard one. I didn't prepare that one. So maybe that's something I can do in real time, just so that you can actually see how I measure the performance of these portfolios. That one's a pretty simple one, so we can go from there. So I'll start with the organic couch potato. Forgive my, big, messy spreadsheets, but this is how we do it when it comes to measuring performance. What I want to do is just show you that I start with what I call a normal portfolio performance. Let me just get this so that I can still see the chat, because I do like seeing the chat, just in case you've got some questions. And so you can see here for a very traditional portfolio, what I did is I took the sort of the classic Canadian couch potato approach. This does have what we call a home bias. So it is 20% Canadian equity or Canadian stocks, 20% US equity or US stocks, 20% global, or this should probably actually be international, is the definition that they use here, because this is not US, this is sort of the rest of the world, and then 40% very standard bonds. The ETFs that I chose, XIU, very standard Canadian equity ETF. The US and international ones, I did go with US dollar ETFs. Most of my model portfolios do include US dollar ETFs for the majority of the non-Canadian assets. So I wanted to keep things sort of as consistent as I could. So that's why I chose these US dollar ETFs there. And then for Canadian bonds, I've got XBB, which is again a very, very standard non-sustainable bond ETF. If we look at the performance year to date, so this is going to be since January 1st. So this is like so far in 2020. You can see that all of the stocks on the standard benchmarks are down. US sort of the least amount. From there, Canadian, and then the rest of the world is sort of down a fair bit. But you can see that bonds have actually done quite well during this environment. Again, no surprise here. When stocks fall, bonds are expected to go up. Because all of the central banks cut their interest rates, that pushed the value of our bonds up. So you can see that bonds are really what's keeping portfolios afloat right now. And so far, year to date, things are very flat. That if you invested starting on January 1st in a very standard portfolio here, you would be about flat. When we look at the sort of historic returns, you can see over the last year, so the last half of the year, last year of 2019, was actually pretty decent. You can see it's really being carried by the US equity. That the US stocks have done the best over the last year, over the last 3 years, over the last 5 years, and over the last 10 years. The US stock market has been the strongest. So you can see here, sort of these returns, very flat year to date, but, about 4.5% over the last year, close to 6% per year over the last 3 years, about 5.5% over the last 5 years, and about close to 7% per year over each of the last 10 years. Not bad. You can see that the volatility and sort of the crash that we had recently, because it bounced back, really hasn't impacted the long-term results too much. From there, I'm going to start with my organic couch potato portfolio performance. So this is one of my most popular ETFs, which is the organic couch potato. So you can see here, for Canadian equity, I've got the Jansi Social Index. For the US equity, I've got SUSA, which is a very standard US equity ETF. I've got some green equity in here, so about 15% for green equity. I've got EAFE, which is Europe, Australia, Far East, and emerging markets, that I did have to sort of split those up. So really, instead of 20% each for like Canada, US, and the rest of the world, I did about 15% each for Canada, US, and then the rest of the world. And then that kind of carved out my 15% for green equity. And then the other change that I made is that these are just Canadian government bonds, so no corporate bonds in here, and that I do have my impact bonds, which I've got solar share bonds, I'm kind of assuming that we got in the old rate, which is 5% a year. Now these are currently being sold for 4% is the new offering this year. So, I could update this and do 4% and kind of show you the impact there. When we look at it, you can see that the Canadian equity, this Janssy Social Index, has really been dragging. This has been like the biggest disappointment for me. If you look at it compared to XIU, really the Janssy Social Index has been underperforming. I've got a lot of feelings about this. I've got, I think a sense of why that is. I won't get too deep into it right now. Maybe that can be something that I look at on a future episode where maybe I can look at like Canadian equities and then US and then kind of do it by country. But just know that, Canadian equity has been dragging. However, if we look at US equity, it was negative for the standard one, and this SUSA is actually up a little bit. As well, our green equity, clean tech, has jumped back up. From there, it would really be a combination of these two, would be sort of our international equity, which is going to be about where they were. And then our government bonds have just slightly outperformed the standard bonds. No surprise there. I think people are looking for a little bit more safety right now. So what this means is you can see sort of the totals down here. I'll compare them with the totals here. Year to date, the organic couch potato portfolio has outperformed by a tiny little bit. Again, this is designed to do just as well, really to kind of track. My goal is to do just as well as the standard benchmarks. So it's nice that we did like a tiny little bit better. If we look at it over the last 12 months, again, it has outperformed by just under a full percentage. From there, the 3-year performance is going to be very, very similar. The 5-year performance, the organic couch potato did do a little bit better. Although the 10-year performance, it is still dragging just by a tiny little bit. So, this is what I expect, from the organic couch potato portfolio. It is really designed to do about the same as the traditional portfolio. And you can see here that that has been the case. So as far as I'm concerned, that's kind of like a win that this portfolio is doing its job. From there, I'm going to move on to my fossil fuel-free portfolio. Now, this is the one that before there were all of these fossil fuel-free ETFs, I had to kind of like create my own. So because all of the standard geographic ETFs, things like Canadian equity, US equity, global equity, that those were all, did include fossil fuels, even the socially responsible ones. What I had to do is go through and do, for example, global real estate and global healthcare and global industrials and do it sector by sector. This allowed me to completely remove energy and remove mining and remove utilities. And those are the 3 sectors that have the biggest sort of carbon footprint and exposure to the fossil fuel sector. So I just took them right out. What's left are all of these other sectors. Now it's interesting, I should probably update my percentages because when I created this, I think it was probably back in about 2016, you can see that financials was the largest sector. And at that point, it was higher percentage than tech, which is why in my portfolio, I tried to sort of align it to have financials at a heavier weighting than tech. Now, obviously, tech has just been doing so well over the last bit. Look at these returns. Year to date, this is like, despite the crash, tech stocks are up 18.5%, which is just absolutely absurd, while financials are down 21%. So it's really interesting to see this, and obviously that these percentages, if I show you the all country world index, if we look at that standard benchmark that I used sort of way back when to be able to determine my percentages, at that time, financials was heavier than tech. And we can see here now, if I do by sector, tech is way heavier than financials. So I'm probably going to want to go through and update all of the percentages on my fossil fuel free portfolio. But I didn't, when I was measuring performance, I didn't want to like cherry pick and be like, ooh, tech is higher now, so let me update it on this before I update it on my portfolio. So I wanted to kind of be honest with it, which is why I did keep technology at this lower percentage. But I really feel that I need to go and update these percentages to align with the All Country World Index as it exists today. Needless to say, you can see, certain sectors that have done poorly, like real estate, industrials, and financials have been sort of the laggards for this year. Meanwhile, tech has done very well. And look at this, green energy, this smog ETF up almost 15% so far this year, despite the crash, which is just remarkable. So again, if we look at our standard benchmark here, our normal portfolio performance here, you can see that the fossil fuel-free portfolio has outperformed. With CoPower, I did lower it. That again, historically, they did offer 5%. With this one, I was like, let me do the offering that they have right now, which is 4%. So I just did knock it down a little bit there. I could probably do 5% for the historic ones, but I wanted to err on the side of caution here. And you can see that the fossil fuel free portfolio has outperformed year to date. It's up about 1.3% versus flat. Over the last year, it's done well. I mean, so much of this would be due to the collapse in energy prices. Obviously, we just avoided that entirely. What it means is that we've outperformed over the last 3 years and over the last 5 years and over the last 10 years. So anyone that tells you that, divesting from fossil fuels, that, that's bad for portfolio performance, obviously I don't have the crystal ball. I can't promise you that, going forward that this outperformance will continue, but it's really nice for me to be able to see that investors have not had to sacrifice returns at all to be able to divest from fossil fuels. From there, I'll show you the easiest pie portfolio. So this is a bit of a newer one. You can see here I've got this DRFG, which is the Desjardins fossil fuel reserves free ETF. Now, we don't really get much track record here. So, I've really only got year to date and the 1 year performance. That this one has been around for, probably about a year and a half. So it'll be exciting to track it once we have a longer track record on it. So you can see here, Desjardins, as well for Canadian government bonds, went with a slightly different one. This is part of the model portfolio, so I wanted to keep it true there. CLG, which is the 1 to 10 year laddered government bond index ETF. And then for impact bonds, if I do show you the one that I had before is no longer available. So originally in my easiest pie portfolio, I had this Kindred Global Impact GIC. Now, unfortunately, this is no longer available. Instead, what I've done is I have replaced it with a new GIC from Kindred. Instead of Oiko Credit, which is microfinance, this is going to be the 1 year Crisis Care GIC. So this is a GIC that actually goes to help people and businesses that are struggling due to COVID. So they've got this GIC. It is a fairly low rate, 1.35%. So that's what is sort of dragging things down just a little bit. What I did is took like a half year because, really we're about halfway through. So I did 1.35 divided by 2, but for the 1 year did the full 1.35. You can see here that the portfolio has performed about as expected. Again, very similar to the standard portfolio performance, which was flat. Although these are all in Canadian dollars, so maybe I should switch up my benchmarks a little bit there. And that over the last year, over the last 12 months, we did earn about 3.66%, which is lower than the standard portfolio. Although, again, maybe I should have switched up that benchmark because everything is in Canadian dollars. I've got a question here from Jeff. Seems like there is a tension between maintaining the portfolios as is to measure performance over time and updating them to take advantage of newly available investment products. Absolutely, Jeffrey. This is like the bane of my existence is like with these new ETFs, I get so excited about them and I'm like, oh yeah, this will be great. And then it's like, but if I do it, then I can't really show the performance. So this is why I'm never in any hurry to update my model portfolios. For example, the organic couch potato, I'm going to talk about this in a minute because I did get a question through email about it. But, I am tempted to sort of update these ETFs because there are new ones available from iShares. So we'll talk about that in a little bit. But, that said, it's kind of nice having the track record where I can go back and I can do the math to be able to see that performance. So when it comes to the easiest pie portfolio, again, returns have been right where we expect them. Really the standout in terms of the portfolio has been my Squeaky Clean portfolio. And again, this is a new one. This has ETHI, which is the Horizons Global Sustainability Leaders ETF. Here, why don't I just bring it up so you can see it on my website, because it's nice and pretty here. So my Squeaky Clean portfolio, I've got the Horizons Global Sustainability Leaders ETF, but because it's not quite as diversified as I want, I do have it alongside this iShares MSCI Global Impact ETF, which is aligned to the Sustainable Development Goals. And then the BMO Government Bond ETF, which again is a little bit newer, but is cheaper than the iShares version. And then I did the Sketch Community Bond, which they've put that one on pause, but they are expected to resume raising that money this fall. So that one is at 3% return per year. So actually this, I should lower this because that should only be half. We're only halfway through the year, meaning that we would have only earned 1.5% so far. So you can see this one like has been the real winner. That if we look at it over, I really only have the performance over the last year. ETHI and ZGB, neither one of them have been around for 3 years. But if we look at this, this one has actually performed. Year to date, despite the crash, the Squeaky Clean portfolio is up 9.79%, which is remarkable. If we look at it over the last 12 months, like, wow, investors that went with this Squeaky Clean approach should be thrilled that in the last 12 months, they are up 18%, which is just incredible to me how ETHI and SDG have performed over the last year. I certainly wasn't really expecting this. Obviously, no one was expecting COVID to happen, but certainly this one has been the winner. Now, the tricky piece is coming up with a benchmark. Because, when it comes to ETHI, they're not trying to track the All Country World Index. So really, the one that they are trying to track is this XQQ, which is the NASDAQ exchange. So this isn't trying to track the All Country World Index. Instead, it's kind of trying to track the NASDAQ, which itself has done really well. This starts to explain why ETHI has outperformed. The NASDAQ is a US exchange that does have a lot more tech companies on it, and we saw how well tech did in a previous portfolio. And you can see that ETHI has really benefited from that tech allocation. However, it didn't do as well as the NASDAQ itself. That said, the SDG, which is the iShares Global Impact, there really is no benchmark for this. So I did do the All Country World Index, and then I did have my bonds as that sort of standard bond ETF. So you can see here 10.63, 18.44 versus 9.79, 18.29. So you can see that, compared to probably this better benchmark, that the Squeaky Clean portfolio has underperformed just a tiny little bit. However, obviously compared to like any traditional portfolio that people have, if they are using the standard benchmarks, this Squeaky Clean one has just done incredibly well. So, I'm really doing this different benchmark just to help you really sort of understand that. Now, when it comes to why don't I just do my Vanguard cheap as fuck ESG. I can just show you sort of how I do this, right? So if I do this, so this is going to be the Vanguard cheap as fuck ESG portfolio. Basically, when it comes to this, we've got Canadian equity, we've got US equity. And then we're going to have what's called international, which is the rest of the world minus US equity. And then from there, we're going to have Canadian government bonds. And I don't think I actually have any impact bonds on this. So let me just verify that that's what I've got up on my website. And I'll just show you how I track this performance. So yeah, it's a 3 ETF portfolio. You can see I've got the Vanguard, ESG US Stock, ESGV, VSGX, and then VGV are my ETFs here. So this is going to be ESGV. ESGV. This is going to be VSGX, and this one is going to be VGV. What I'm going to do is just clear the contents here. and that these guys, these are so much cheaper. This is, what is it, 0.12, I think 0.15. I'll confirm these. And then I think that Vanguard one is a little more expensive. But let's actually confirm them when we look them up. So to look up performance, I like using a website called Morningstar. This is, Yahoo Finance is just fine, but when it comes to ETFs, I find that Morningstar just is a little bit better. And what it does is allows me to do things very, very consistently. So ESGV, we can start with this one. Let's get the fee on it just so that I do know 0.12, so I was right there. From there, what I can do is get the portfolio returns here. So year to date is going to be 3.03, 3.03, and then the other one is, the 1 year is 13.29, 13.29 over the last year. And again, U.S. equities have just been really, really strong. Oh, I should probably update these percentages because I think I did it as 30, 30, 40. So let's do that. So we'll do 30, 30, 40 there. From there, international equity probably hasn't done quite as well. It tends to be lagging a little bit. So if we do VSGX is going to be here. This is compared to the Vanguard International Stock ETF. We can see here 0.17 is the MER. So 0.17, I'll just calculate that. Oh, Deb Matthews, hey mama. Uncle Tim, you're watching from the cottage. So I've got my family watching, my mom and my nieces and nephews. Fantastic. Such a benefit of doing it during the day. We actually get some younger viewers. It's never too early to start learning about financial literacy. So year to date, we're down 5.5 or 5.47%. So we're minus 5.47. The 1 year performance on it is going to be 2.3%. So I'll punch that in. From there, let's look at VGV. You can see why this is a little bit tedious. This is why I try to do it ahead of time. But I think it's nice to be transparent about everything. We can see the MER, this one's a little more expensive, 0.28. So let's do that, 0.28. From there, what we're going to do is look at the year to date and the 1 year. I do expect these to be a little bit higher just because bonds have done a little bit better. 7.93 and 8.46. Perfect. From there, let's just do a little math here. We're going to do this times this plus this times this plus this times this equals 2.44%. What I'm going to do is just lock these guys in because they're going to stay consistent. So I just use the little dollar signs there. And what that's going to allow me to do is copy and then paste it there and then paste it there. So you can see the fee on this one. I guess I probably shouldn't swear. The reason these are cheap AF is because the fee on it is about 0.2% overall. And again, there is a cheaper Canadian government bond. I just wanted to do them all with Vanguard. From there, you can see, 2.44, 8.01. A nice benchmark for this, what we can do is very, very simply is use, because these are both US dollars, so we should be able to use VT. Oops, sorry, I don't want that. Instead, what I want to do is just use VT, which is the Vanguard Total World Stock Index Fund. So this would be the entire global stock market in one ETF. And here I can get the year to date, and the 1 year is 4.23. And 4.13. So you can see here with this guy, it would be this VT. So I'll call this Global Equity VT. And this one, again, would be those two combined. So it'd be 60%. Perfect. And then what we would do is just use a standard Vanguard bond product. I forget Vanguard bond ETF. I forget what their standard one, the ticker symbol is. We might know this one. Let me just do Canada. Here it is. VAB is going to be the standard one there. So we can just do Canadian bonds, and we can do 40%, and this is going to be VAB, and we'll get the performance here, lickety split. VAB. So when it comes to performance on this one, this is going to be, here we go, year to date is 7 flat, and then 8.08. So 8.08, which means that I can just do very quickly equals this times this plus this times this equals 0.5%. And let me just lock in these. And you can see here 5.71. So in this case, no surprise here. Surprise, the fossil fuel free ones again have outperformed their benchmark. This is because fossil fuels are so poor, have just done so poorly over the last year that really, looking at these, I'm not shocked that this Vanguard cheap ETF, now this one would be a little bit cheaper, right? If I looked at the fees on this one, they are going to be cheaper. The Vanguard bond one, 0.9%, so even cheaper, 0.9. And then this one is, again, these are just some of the most popular ETFs in the world, which is why they are just so inexpensive. 0.08. So, and this is, 0.9, it's 0.09. There we go. And so again, I can just take this and show you that, 0.084 would be our expected return here. So let me get to some of the questions. Daniel, do MERs ever change, go down over the lifetime of an ETF, or are they always static? So they can go down over time. This is totally dependent on the ETF provider. And sometimes they do come down. Horizons, ETHI, part of this Squeaky Clean portfolio, this one did come down. It was, I think, 0.65, then they brought it down to 0.45 as well. A lot of the iShares ones, so I think these in my organic couch potato, SUSA, ESGD, and ESGE, those fees did come down as BlackRock introduced new ones. So it's really up to them. For the most part, in my mind, I do expect the ETFs fees to stay static, although sometimes they are lowered in order to keep their competitiveness. What we saw for the longest time, these sustainable ETFs were more expensive. The fees were just higher. That's just how it was. But now that there are more and more ETFs coming out, they're starting to compete with each other, so the fees have come down. As well, my dream is that they become more popular, and that as they get more assets under management, the fees will come down, that there is a little bit of sort of an economy of scale here, that as more people invest in these funds, it does allow the companies to lower those fees. So hopefully it comes down, but we just don't know for sure. So that's why I expect them to stay the same. And then if they come down, then I'm just happy and do a little happy dance. From here, question from David. Are the returns listed on Morningstar for the US listed ETFs in Canadian dollars? Or should I be taking the exchange rate at the beginning of the year and at to date to get the actual return to date? So yes, if I was being really, really precise about this, I would normalize absolutely everything in Canadian dollars, which I am not doing. I do not have the patience to do that, frankly, because it would be different based on the year to date, and then the 1 year, and then the 3 year, and then the 5 year, and then, so, really what I'm trying to do is just show it relative to the benchmark. And if I can get a benchmark that has a similar currency, then in that case, I'm going to be happy with that. The way this works is you can see that all prices, if I look at the returns, they have the little thing, all data based off of NAV, which is the net asset value, which is going to be in its home currency. So when it comes to this, VT, Vanguard Total World Stock ETF, this is a US dollar ETF. I don't know if it shows me anywhere on Morningstar that it's US dollars, but I just know, oh, here it is, USD. So really what we're looking at here is this NAV, this net asset value, which is going to be in USD. What this means is that there are going to be some little currency variations. So that's why, what I've tried to do is when selecting my benchmarks, also selecting funds that are US dollars for that portion of it, right? That's why I said, especially with the Easiest Pie portfolio, I probably should have had a different benchmark here, just because these two funds are in US dollars, whereas kind of the point of the Easiest Pie is that they are all in Canadian dollars. So I should probably update my benchmark here. Why don't I just highlight these so that maybe I can do that for next time? And then obviously when it comes to my, the Vanguard one, these are in US dollars, which is why I did US dollars here. These are in Canadian dollars, which is why I did Canadian dollars here. So, if I really wanted to see the, what the actual performance was for an investor that did this, then yes, I would need to normalize everything in Canadian dollars. I just don't want to do that right now. So that's why I'm happy just showing it in its home currency. And then hopefully I can just be strategic with the benchmark to show you that relative performance, hoping that my currency fluctuations are very, very similar there. Okay, question from Drew here. Hi Tim, I only have ZGB for my bonds to avoid oil pipelines, etc., but it's all Canadian. Yes. In my opinion, what about using B green or green B for some diversity to corporate bonds? Yes or no? Which one? How much? Thanks. Okay, so this is a cool question. When it comes to bonds, that really I tend to keep it simple, keep it safe, and just do Canadian bonds. This way we don't have any currency risk. You'll notice all of my bonds were in Canadian dollars. And if we want to avoid pipelines and any fossil fuels, really the only way to do that right now is through Canadian government bonds. So what Drew is referring to here is that there are, I believe it's GRNB is the first one to come out. And then B green is a little bit newer. So this is the VanEck Vectors Green Bond ETF, which sounds awesome. Okay, I'm in Canada. I am an individual investor. Go. Okay, it kept me in US, but you know what? That's fine. And I agree to that. So here we go. So this is a green bond ETF. What this means is that these are the index comprised of US denominated, dollar denominated green bonds that are issued to finance environmentally friendly projects. So these are going to be things for like renewable energy or smart grids or energy efficiency. These are going to be, you can see here, includes bonds issued by supranational government and corporate issues. So supranational, these are going to be things like the European Investment Bank, right? The World Bank. Those are supranational. They are beyond national and include a bunch of different countries. Governments obviously are going to be different countries around the world, and corporate issuers. So these are going to be corporate bonds in here as well, but they're just going to be green bonds. So when we look at the type of bonds that are in here, you're going to see things like, here we go. Let me go up to the top here. Here we go. Fannie Mae. So this is going to be green bonds. Fannie Mae is a U.S. lender for real estate. This is going to be about energy efficiency upgrades, for products. This is green bonds. It's just awesome. The Chile government bond, European Investment Bank. Don't ask me to pronounce this. I call this KfW. This is a German government-owned bank that has issued green bonds. Bank of America, European Investment Bank, Boston Properties, Bank of China. You can see all these different. Apple did $1 billion green bond, right? So these are all going to be green bonds that are global. Now, the problem with this is a couple different things. The first is that this is denominated in US dollars, meaning that we do have currency risk. That if you're planning to retire in Canada, we're going to retire using Canadian dollars. We are going to be a lot more impacted by that currency exchange risk. When it comes to our stocks, even though we might hold Canadian dollar funds, if those funds include US companies and global companies, that's going to have currency risk as well, which is just fine. However, when it comes to these green bonds, the returns on them, the yields on them are going to be very low. You can see here, 1.69%. And that my fear is that the currency risk is actually going to fluctuate more than these different yields. So just know that like the reason why I tend to do just Canadian dollars is to keep it simple, to keep it safe, which is the point, to avoid that currency risk. That said, to input a little bit of these into your portfolio, I would have no issue with that whatsoever. You can see here that it is mostly US, but there are some other things. These supranationals are in here, right? But the currency exposure is US dollars. So I just want to be clear that you are taking on US dollar risk, which when it comes to bonds, because the expected returns are lower, that currency risk could, impact your returns more than the interest rate, which is why I tend to avoid it. That said, if you really wanted to do it, I would have no problem doing that. What we would do is carve it out of your bond portfolio. So for example, if you wanted to put them in this Vanguard ETF, instead of 40%, I would still want most of it to be in Canadian dollars. So maybe like 30% Canadian dollar bonds, government bonds. And then maybe what you could do is carve out 10% of that 40, or of the total. So do 30% government bonds, 10% green bonds, something like that. Obviously, if you've got impact bonds, so like community bonds or solar bonds or something like that, that's going to drop it even lower. You might want to do less. Really what I'm trying to say here is that most of your bonds should be in Canadian dollars. However, you can carve out part of it for these green bonds. Let's take a quick look at BGRN, which I think is the newer one. This one was launched, when did this one launch? March 2017, whereas this one is from iShares. I think it's newer. I remember looking at them. Let's see if I'm right on that the inception date on it, November 2018, so again, a little bit newer. Really, it's tricky in terms of the two. Let's look and see what's inside this one. We can look at the exposure breakdown. Nice mix of short, medium term, and long term, although it does look like more like medium term bonds, which I'm fine with. You can see here, this has a lot of French bonds. Fascinating that I guess France is all over that. I've been hearing the stories about what they're doing in Paris. And it doesn't shock me that France is a little bit ahead of the curve here. So less exposure to the US compared to the VanEck vectors and more exposure to France. It is what it is. From there, you can see here, agencies, financial institutions, different organizations here. And then the credit quality should be quite strong, AAA, AA, single A. Although there are a fair few triple B, these would likely be a lot of the corporate bonds that would be in here. When we look at it, I just want to see the yield on it. Now, it's a little bit tricky. VanEck Vectors, their yield, they give me this 30-day SEC yield, 1.69%, which is quite a bit higher than the 30-day SEC yield for this global green bond ETF. So this tells me that there might be more bonds in here that are government that have a lower coupon or interest rate. It's going to be tricky. Let's do a quick little chart just to see, or let's look them up in Morningstar maybe, just to see that total return. So GRNB, we can start with this one, which is the green bond ETF. And look at the returns, and you can see here, year to date, 5.5, and then 6.28. Let me do a side-by-side comparison and do BGRN, which is going to be the iShares version, which if we look at the returns, 3.48 and 5.1. So a little bit lower return on the iShares one so far. I'd have to dig into it, a little bit more. to be able to understand why. My guess is what we would call a lower coupon. Let's see if it gives us the weighted average coupon, which is a metric that I like. I don't think it will. You know, the fees on them are going to be pretty similar. 0.2 versus 0.2, fantastic. These might be more consistent. So the SEC yield, 1.75 and 2.19 versus 0.54 and 3.58. That's interesting that the 12-month yield is higher there, but the SEC yield is lower. So again, I'd want to dig a little bit into them, but if I had to pick one, I'd probably pick the one that's been around a little bit longer. That said, if the goal was global bonds, you know, the iShares one might be a little bit more global, less exposure to the US. Anywho, in my mind, it's a coin toss. Honestly, they're both going to be very similar. They're both going to do basically the same thing, which is give us exposure to those global green bonds. Really, my concern with it is the currency risk, which is why, you know, I don't make it like a standard part of my portfolio. You know, so glad. It seems that B Green has more number of bonds. Does that matter? Not really. In terms of diversification, you know, more bonds would be better. But, you know, really both of them are going to have pretty similar diversification. I don't see it being like a deal breaker for me. Let's just take a look at it. That this one, oh, that's the All Country World Index. Here we go. So if I look at the holdings, this is the VanEck Vectors one. Total holdings 149 versus iShares. I think you've told me has more. So let's look at all. And let's see this. Oops, I need to scroll over here. 435. So it is more diversified. That said, you know, really it's going to come down to these top issuers. I don't care the number of bonds, right? It's going to be the breakdown by the issuers. What I'm seeing here is that the iShares one is more global, with France, Europe, KfW, which is German, Société du Grand Paris, Netherlands, you know, NG, which is European Utility, Belgium, SNCF, I don't know, Tenant, and Asian Development Bank. So the biggest issuers are much more European, whereas the biggest issuers when it comes to the VanEck Vector ones are going to be, I believe, the US ones. Sector weightings, maturity. Yeah, it doesn't give me the biggest issuers, but, you know, we can see here that the US being so high, you know, that's really going to be the big difference. Okay, question from Christine. Do I subtract MER from the returns? Yes. All of the returns that I'm looking at, because we're using this Morningstar, the methodology that we're using, let me just bring up one of the ones. So I can do, for example, the Janssy Social Index, XEN. This is one of the first ones I looked at, probably the first one that I looked up. And when we look at it, what I'm doing is using this total return metric. So the total return is going to be the buy low, sell high, which is the change in the price, which includes the fee. So this is going to be minus the fee plus the dividend. So the reason I'm not like charting them on Yahoo Finance, which I often do, right? This gives me like a quick glance. I can be like XEN and look this up, right? And I can get .to and I can get the iShares Janssy Social Index. If I look at the chart, you know, over the last 5 years, I can see XEN. This is just the share price. So this is going to include the fees, but it's not going to include the dividends. You can see they kind of show all the dividends here. That's why I really like using Morningstar, and I like using this total return metric. That is going to give me the change in share price minus the fee plus the dividend, which is that nice all-in return. Hopefully that answers your question. A question from Mark, which says, or maybe a comment that says, the new iShares ESG ETFs are super cheap. I know, I love this competition. Maybe they'd be suitable substitute alternative for my cheap AF portfolio for those wanting to keep everything in Canadian. Yeah, absolutely. I mean, I would probably replace them. I would probably put them in my organic couch potato. That, you know, honestly, really to me, this idea, because they're Canadian, US, and the rest of the world, that's likely where they would fit. In fact, I did have a question from YouTube from Vinny. Says, since I'm doing a portfolio review, can I share where WSRI and WSRD, these are the new ones from Vanguard, and then the new ones from iShares, XCSR, XDSR, XUSR, and any new favorites might fit into my model portfolios, or would I create a whole new model portfolio for any of these? So, I mean, they are their own portfolios. They're always going to be new, but in my mind, the way they fit in really nicely is with this organic couch potato portfolio. That's because it's 3 ETFs. They're divided by region, you know, Canada, US, and the rest of the world. I would probably do it through here. You know, the easiest pie portfolio, I really like that it's like the one fund solution to keep it as simple as possible. So I think I'll keep Desjardins in there, but I might update the organic, or I might create them as new model portfolios. I'm kind of making some decisions. It's time for me to move past my Sustainable Economist blog. So a big mission for me over the next little bit is going to be to sort of update this, to come up probably with a new brand, and to come up, you know, really I've been looking at Canadian Portfolio Manager. So this is a site, I believe it's by Justin Bender, I think, is who did this. Let me just see, make sure that it is Justin. Yeah, here it is, Justin Bender. So, you know, this is his. It's nice and it's clean. He's got these model ETF portfolios. He's got a little toolkit and some video tutorials. So, you know, I'm kind of tempted to sort of like follow this a little bit and really to make it a listing so that I can have a bunch of different model portfolios, but also have it as a bit of like a build your own portfolio guide so that people can choose what options they want depending on their values. I'm tempted, what I'm thinking of doing is doing it as my name. But right now, timnash.com is taken by this very handsome gentleman. This is the entire website, is this photo with Tim at timnash.com. So I'm kind of looking forward to this interaction. I'm going to have to email Tim at timnash.com and say, hi, Tim Nash. My name is also Tim Nash. Any chance that you're willing to sell me your URL? I don't know if he's going to go for it, but, you know, really, I would say keep an eye on it. I'll let you know. But I think that, you know, I developed this Sustainable Economist brand back before I really knew what I was going to do, and really before I had this narrow focus on sustainable investments, when it was a little bit broad about the green economy. As well, you know, I think that I built it using this site called Nation Builder. I think it's down at the bottom, created with Nation Builder. So, you know, it's just not the best platform now. There are some other options that are going to be a little bit better. So, you know, fingers crossed it'll happen later this year. I've been meaning to do it for a while, and, you know, hopefully I can get that done.